Good afternoon and welcome to the Mint Funds and Market Update. I'm Kirsten Boldarin, Group CEO. First of all, if you could note the disclaimer regarding this webinar. All right, turning now to outcomes across various key indices, we can see that the returns from global stocks continue to dominate. And this was certainly the case again in October with another strong month from global stocks. US corporate earnings remained robust, and we had the additional assistance of a Fed rate cut with the AI thematic continuing to perform really strongly. Stepping back from markets to rather consider the US economic outlook, we can see that the economy has normalized following the off-the-chart extremes that we reached during the COVID decline and subsequent recovery. Inflation has come back, and whilst it's still above the Fed's target rate, it is certainly now within shooting distance, and US GDP growth remains reasonably robust. I guess the only item that would be potentially cause for concern is that unemployment rate, which continues to tick higher, and is the reason why the Fed has felt comfortable reducing rates even though inflation remains above target. Now, if we go back 18 to 24 months, many investors were concerned during that period when the Fed was actively hiking rates that this would result in a recession, and this has not transpired. We think part of the reason why a recession hasn't come to pass has to do with some structural changes within the US economy, where it has moved very much from being a cyclically driven manufacturer to much more of a goods and services, to much more of a services-focused economy. And so the chart there on the left just shows as a percentage of GDP the contribution from goods, which is the green line, and the contribution from services, which is the pink line, and just how disproportionately skewed towards services the US economy is. And then if you look at the chart on the right, what has also helped the US to avoid recession is the fact that consumers have retained spending power. So net worth as a percentage of personal disposable income has continued to ratchet higher. And in fact, we would argue is supported due to the nature of where wealth is distributed in the US, has actually been supported by higher interest rates. So continuing on with that theme and noting that spending power is not evenly distributed in the US economy, and that's the case on a socioeconomic basis, but also on a demographic basis. And this too has changed over the years. Now, it's natural as you age that you build up net worth, and then as you reach old age that you start to accumulate. However, what we've looked at is a comparison between different age cohorts between 1995 as a percentage of total wealth in the economy versus 2025. So what you can see is that in the last 30 years, as a percentage of total wealth, that 40 to 54 age bracket has declined quite materially, whilst that 70 plus age bracket has increased. There is also in the US economy quite a big difference between the wealthy carrying high cash balances and those in lower socioeconomic groups carrying much more mortgage debt. So much more non-mortgage debt. So high interest rates are obviously helpful for those who are very cashed up, but very painful for those who are carrying more debt. And whilst this doesn't necessarily have direct implications from a day-to-day market perspective, it may well have implicit political implications and could be a good explainer as to why we've seen such a strong pull towards populism in parts of the world that share these demographic features. There's been a lot of market commentary recently about whether or not AI stocks are in a bubble. Unfortunately, it's almost impossible to call a bubble until it has actually burst. And what we would say is that to date, although valuations in AI stocks are high, to date they have been well supported by earnings. So if you look at that chart on the left, it just looks at the earnings growth year on year of the Max 7 stocks versus the earnings growth of the rest of the S&P 500. And earnings growth for those Max 7 stocks have far outstripped that of the rest of the market. However, that differential is beginning to narrow. So when you look at the forecast earnings for 2026, the difference between the expectations still ahead, but the difference between the expectations for the earnings growth of the S&P 500 ex Mag 7 has narrowed somewhat to those with Mag 7. And then just looking across at the chart on the right, so just proving that point again is that the 12-month profit margin for the S&P 500 in that information technology bucket has again been far superior to the rest of the market. So we would say that a lot of the growth stock market related appreciation is quite well supported by the fundamentals. But that's not to say that we don't have concerns. And one of the key topics is just the extent to which AI-related CapEx has been heavily supportive of US GDP growth. So the chart there on the bottom right just shows the contribution to GDP from CapEx expenditure. And that has made a material difference in terms of the outcomes for US GDP growth. So whilst we don't believe that we can call the top, there are certainly some legitimate concerns about the self-fulfilling or self-feeding mechanism that's currently in place. And really our response to that is to continue doing what we have been doing, which is to hold a really broadly diversified exposure to global equities and avoid some of that excess concentration that is present within market indices and also increasingly within personal portfolios. Turning to New Zealand now, we actually believe there are some signs of life in the New Zealand economy, which are on the way. And if you look at this chart, which shows debt servicing as a percentage of disposable income for the New Zealand household versus the US household, you really see the impact of the nature of our mortgage market and the debt pass-through mechanism, servicing pass-through mechanism. So obviously as interest rates go up, and you can see that pink line, which is the New Zealand debt servicing component as a percentage of household income, just that pain that we've been feeling over the last few years from interest rates really ramping up and being passed through quite dramatically to us. But what goes up also does come down, and we are now starting to see a bit of a turn. So as interest rates come down and those get fed through directly into mortgage rates, perhaps not as quickly as we would like, that should provide some relief for the New Zealand consumer to be able to start spending a bit more as opposed to feeling very under pressure. Stepping back from the economic dynamic and just really looking at the New Zealand market dynamic. In terms of the listed markets, that recent RBNZ 50 basis point cut had a marked impact on the New Zealand equity market. You might not have seen it at the headline level, but at certainly within small caps and also cyclical stocks, they really reared back into life. This data complements a Forsyth bar, is the chart on the right, runs to the end of September. And so to match it, the chart on the left is also 1 year data to the end of September. But really that same dynamic persisted into October. And really what we would say is that this is the sign of classic recovery. And so what you get is that relief rally where some of those smaller companies that were perhaps of significant concern, and also some of those cyclical names, suddenly get the benefit of that rate decline and really start to come back to life. Our expectation is that some of that initial relief rally fades and really that the market rally broadens out into some of the larger cap stocks and into some of those structural growth names where Mint has typically had exposure. Moving on to the funds specifically, so the Mint Diversified Income Fund generated positive returns in the month of October. So the fund was up approximately 1.3%. And this was largely generated from the rally in domestic equities, with SRG, which is an Australian listed infrastructure services business, making significant gains on the back of an accretive acquisition, and that was very helpful from a performance perspective. Fixed income, as you might expect, was supported by the rate cut, but going forwards, we continue to maintain an above benchmark allocation to cash, in light of some of those fuller global equity market valuations, and also the fact that credit spreads have tightened in quite significantly. Moving on to the Mint Diversified Growth Fund, we had positive gains from both global equities and domestic equities. Again, SRG was a strong positive contributor for us, but we had some additional global equity support from improved results from Thermo Fisher and some encouraging signs from LVMH, which indicated sort of healthy end demand both in the US and Asia. A couple of negative contributors were Comcast and ADP. Thank you for your time, and we look forward to speaking to you again next month.